How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic I want to discuss with you, should I buy a long-term care insurance policy? And more importantly, talk about what is the significant shift that has taken place regarding typical or traditional long-term care insurance, and then how individuals could leverage annuity contracts and life insurance contracts to suffice where the current long-term care insurance policies are lacking. So I'm going to talk about how long-term care was first developed, what is the benefit of getting a regular long-term care insurance policy, what was the dramatic shift that took place, and why it might make more mathematical sense to go with more of a hybrid type product, such as a life insurance policy with long-term care benefits or an annuity with long-term care benefits, rather than just putting dollars towards a long-term care insurance policy outright. So the purpose of long-term care insurance was supposed to be met for specific protection in case an individual did not pass away and was living. There might have been a chronic illness, or there might be a chronic illness that occurs, whether that's dementia or Alzheimer's or arthritis or something that is a debilitating illness that cannot be covered but through simple rehab, through a simple rehab facility or rehabilitation, where it becomes chronic and it's more of just masking whatever that problem is. That's what's going to be deemed a long-term care issue. So the problem that happens, or the misconception that occurs, is individuals, when they hit age 65, they're eligible for Medicare policies or Medicare supplement plans. And they think that if they have the Cadillac of Medicare supplement plans, and if they become frail and they need that extra assistance at home to help them get around and make their food, or help them go to the bathroom, different things like that, that Medicare will cover it, or Medicare supplement plans will cover it. And that's simply not the case. In a certain situation that makes sense for Medicare is, let's say if somebody's living and they're in their 70s, and all of a sudden they fall down and they break their knee. Well, if they go to the hospital, Medicare would cover that sort of plan. That's deemed an acute illness. They would also send that person to a rehab facility to help make that knee better. So those are the different things that are covered through a Medicare, because it's known as a short-term illness. Let's say if while they were rehabbing the knee, they realized that there was arthritis all throughout the leg, and there was no way that they could rehab that leg to make it better. It's essentially a debilitating illness that's chronic now, it's arthritis. That would be deemed a long-term care incident, and therefore Medicare will not cover that. So what happens is, when somebody needs to get around, let's say in that example where now they have arthritis all throughout their leg, maybe they can't get up, maybe they can't go to the bathroom as well, maybe they can't make their own food. And there's a process known as an activity of daily living. And that's what qualifies an individual when they're eligible for a specific long-term care insurance benefit, is they need to have 2 out of the 6 ADLs that they need to have help with, or they cannot properly perform 2 out of the 6 ADLs. So the ADLs stand for eating, bathing, dressing, transferring, continence, and toileting. So let's say if somebody's going and they're living, and all of a sudden they have arthritis, they can't move around as well, they need help dressing and they need help bathing. Well, that could qualify as 2 out of the 6 ADLs, as long as the person has a doctor's note that qualifies them for a long-term care illness. Well, then that insurance policy could pay for that cost of care. So with long-term care insurance, you could either have an indemnity benefit, which means that they pay the individual, the insurance policy pays the individual cash, and then that individual either pays that facility, that long-term assistance facility, they pay for that long-term, that home health aid directly, or they pay a family member to come help them out. That's one type of long-term care insurance policy. That's a much more powerful policy than the ones that pay directly to the carrier. So you have the other policies that will pay directly to the home health aide that is coming and helping them out throughout their house, or pay the nursing home to make sure that everything is set up comfortably. It will never go to the person. It would go directly to whatever that facility is. So that's the basic components of a long-term care insurance policy. And the reason why long-term care insurance or a long-term care insurance benefit is necessary is because you have technological advances that keep increasing the longevity of an individual's lifespan. So once again, to my original statement, when you do not die, you live. When you live, you have that chance of becoming frail. You have that chance of developing dementia, Alzheimer's, having some sort of chronic illness, ALS, whatever, that's in a very extreme case, but whatever that situation might arise, there's a very large growing need, and there's a very large amount of claims that go out each and every year on long-term care because people are living longer. Usually what would have been able to they would have been able to pass away in their early 70s, 80s, 90s. Now individuals are living much longer, past their 80s, past their 90s, sometimes into their hundreds, and therefore the body's breaking down, and it's requiring that cost of care to get paid out to help with home health aid or in that specific facility. And the main hook point for long-term care insurance is for individuals so that they don't have to go and dip into their retirement assets. They don't have to dip and do a reverse mortgage to therefore pay for that cost of care, because the cost of care is astronomical, especially if you need a home health aide to come in there a couple of days a week. If you need to go into a nursing home facility, you can go and look at the averages. It is unbelievable per state of how expensive long-term care assistance is, whether it is the home health aide that's coming into the home, or you're actually going to an assisted living facility, or you're going to a nursing home. All those different options are very, very expensive, and that could liquidate retirement accounts, leaving people financially broke and just adding to an additional problem of running short of their monies in retirement when they need it the most. So as a hypothetical example, an individual could start paying while they're healthy. They'd be in their 40s, 50s, 60s, 70s. They could start paying for a long-term care insurance policy, a couple $100s a month, and maybe that might give them, a $300,000 care benefit that could be leveraged for whenever they need that cost of care. Now, a little trick or a little tidbit that a lot of individuals are not mindful of is they automatically assume long-term care insurance is going to cover me if I go into a nursing home. Well, statistically, 80% of the time, long-term care insurance is used for home health aides rather than just automatically assume I'm never going to go into a nursing home. I'd shoot myself before I go into a nursing home, which I've heard many times. I don't mean to, make this into a joke, but this is very, very true of situations that I hear on a daily basis. What typically happens is an individual will have a home health aide that comes in and helps them assist, basically going to the bathroom, eating, making their meals, dressing them, whatever, or, changing out their colostomy bag, whatever that case might be. That's what would qualify for that home health aide to come to the home. So rather than in that situation, let's say you have a retiree or seniors that they have Social Security income coming to them, maybe they have pension income coming to them, and now they have $300,000 of retirement savings that they've been also utilizing for retirement income to help suffice what their expenses are. Well, this could get dwindled away in just a couple of years, and now they could be completely broke with just be relying on the pension, or in most cases, individuals only relying on that Social Security income. So it has a very bad impact when you don't have that specific protection over there. So when somebody sets up a long-term care insurance policy, it's like having an additional bucket of money that's going to be set aside specific for that need. So things used to be pretty simple. Back when long-term care insurance became very popular in the 90s and the early 2000s, an individual would go and say, okay, I understand. I saw my mom, I saw my dad go through this, and I needed a home health aide, or I need to put them in an assisted living facility or a nursing home, whatever that case is. And I know how expensive, how much that completely drained their retirement accounts. I'm not going to fall victim to that. I'm going to go and purchase a long-term care insurance policy. So this was a nice little niche for insurance carriers to go and try to figure out this market space. And I went off of something known as morbidity tables. When you have life insurance is it's utilizing actuarial data on how long someone's going to live, known as mortality tables. With a long-term care insurance, it goes off of what are the chances that somebody needing that assistance of long-term care. It's going to go off of a type of morbidity table to show you, okay, what is the likelihood of us, going on a claim or these claims being paid out. So when insurance companies first wanted to get into this market space, they thought they understood those actuarial data, very, very well, and they would go and set up these plans. Well, since that point in time, majority of individuals, especially when they hit past that age of 70, kept going out on claim and going out on claim and going out on claim. So what it did was it transferred that shift. And now these insurance companies that still offered these plans, they started running for the hills and they said, damn, we do not want to offer these plans anymore. So that's why you had like the John Hancocks had an unbelievable amount of market share in that space. You had the MetLifes, you had the Prudential, just to name a couple of carriers out there. And they started now closing shop on long-term care insurance policies, saying anybody that purchased policies from us will still honor those policies, but we're not going to take on any new business because we're losing our shirts on, basically leveraging long-term care insurance because individuals are living longer and longer, and therefore these people just keep going further and further out on claim, and it's just, we're wasting millions and millions of dollars of constantly paying out these claims, and we did not have the law of large numbers with the premium payments that are able to suffice how many individuals are going out on claim. So it kept preventing companies from being more and more profitable, and it was eating into their profits just to sustain this long-term care insurance plan or this long-term care insurance benefit. Now, to make matters worse, and this is something that just happened recently in 2017, was you had some very large insurance carriers throughout multiple states that even though they stopped offering plans years ago, individuals that still were policyholders, that those companies, those insurance companies, those very large insurance companies, I'm not going to use any names just because, obviously for liability reasons, I do not want to use any company names, but I know of family members that have had long-term care insurance plans, and they've gotten notices in the mail from the last couple of months saying, hey, unfortunately, because so many individuals have been going out on claim, in your contract, it reads that we had the right to increase the premium payments or increase the charges for this insurance. So you have individuals that were expecting a $400,000 benefit that now, if they want to still receive that same $400,000 benefit, their premiums are not increasing 2, 3, 4%. They're getting notices with 80% increases, 90% increases in some cases, and it is completely horrible, and excuse my language, but it's also completely bullshit for insurance companies to do that to individuals. So now those existing policyholders have one of two options. They could either go and pay that much higher premium to get that same amount of benefit, or they could reduce their benefit. So if you're one of those individuals that has an existing long-term care policy, you're watching this video and you're saying, okay, I got this big notice in the mail saying that my premiums are going to increase 50, 60, 70, 80%. What is a way that I could, that I could kind of still stay financially compliant to whatever my budget is? And a really easy way would just be to reduce that benefit. So maybe instead of a $400,000 benefit, you still have a $200,000 benefit, so you didn't have to waste money for all those extra years. One of the other problems with long-term care or traditional long-term care insurance is if you never use that benefit, well, then you've just basically, put away all those premiums, like basically purchasing car insurance, never getting into a car accident, never actually having to use that insurance. You're basically keep wasting those premiums each and every year. So you're basically paying those premiums for that peace of mind to say that you have a bucket of money that's sitting there that could get paid out for whatever that cost of care is. So now, what is the solution? I told you about how long-term care insurance is beneficial, what has essentially happened with that shift, how it used to be simple and now that shift took place. You have a lot of carriers that are getting out of the market space altogether, and the solution are hybrid type products. And you could either do this on a life insurance side, or you could do this on an annuity side. With the life insurance, what happens is the way that life insurance works is an individual is going to be paying a monthly premium, an annual premium. They pay an insurance company for a life insurance death benefit to be over the insured's head, kind of like an umbrella that's over that insured's head. So if you have a permanent life insurance policy, regardless of the person passes away in a week or the person passes away when they're 120 years old, that life insurance, that death benefit is going to get paid out tax-free to that individual's beneficiaries. That's the benefit of life insurance. Once insurance carriers really start stepping away from the long-term care market, one way to incentivize individuals to go more towards and purchase life insurance to cover this long-term care need is, let's say if you have a life insurance and you have $1 million permanent death benefit life insurance policy, and you're paying X amount of hundreds of dollars per month, there's something known as a chronic illness rider, which is a long-term care rider that says that same thing, 2 out of 6 ADLs. If you suffice 2 out of 6 ADLs, the insurance company will allow you, typically it's around 24% of whatever your death benefit is each year that you need that cost of care. On top of it, rather than that benefit get paid directly to the carrier, directly to that home health aide or that assisted living facility or that nursing home, they could provide you that portion of the death benefit or that benefit could go to the individual in an indemnity in a cash process where now they have, in this case, $240,000 that they could leverage and say, I'm going to pay a family member to take care of me. I'm going to pay a home health aide and find private insurance or find a private facility that works off a little bit better. And now I get to decide how to utilize these dollars properly. When you're using this hybrid though, understand that any dollars that you're pulling from your death benefit to use as a living benefit for that long-term care, for that chronic illness benefit, that's going to be negated from your death benefit. So if you're pulling out in this example $240,000, if this person was to use that and then they pass away, well, the beneficiaries are not going to be left with $1 million. The beneficiaries are now going to be left with $760,000. The really neat part about these long-term care benefits are usually they come at no additional cost. So you get set up on it's known as a GUL policy, which is like a permanent life insurance policy with no cash value that's associated with it. And they could add chronic illness riders. So they have some top carriers that give you those additional chronic illness benefits at very inexpensive cost. So it could be also comparable to how an individual is placing dollars aside on a regular long-term care insurance policy, but gives you flexibility to say, okay, if I pass away, well, now I have a death benefit that's going to be left to my beneficiaries. It's not like I just threw all that money away. If let's say I need that chronic illness because I can't, suffice 2 out of my 6 ADLs, I need assistance with 2 out of my 6 ADLs. Well, now I could pull out portions of that death benefit to go and leverage it for that long-term care need. The other way that these hybrids are used is through the annuity platform, and it's not going to be as large of a benefit, but it is just something extra. What happens is these types of annuities out there called hybrid annuities, which are fixed index annuities with income riders. And so when we try to calculate those types of products, we try to calculate how much income somebody needs to suffice what their expenses are in retirement. So let's say if somebody has like a $500,000 of retirement assets, and we say, okay, we need exactly $100,000 has to be put into that hybrid annuity, and that's going to pay this person $10,000 of income every year to the day that they pass away. Some of these carriers already have built-in long-term care that will be a doubler, meaning that they could double what this income is in a cash benefit for X amount of years. Typically it's about 5 years. And then after those 5 years have sufficed, then it goes back down to the original amount. So an example of what I'm talking about is, let's say if somebody goes and they have an annuity contract that has that little long-term care doubler, that long-term care feature, and they threw $100,000, let's say this person is 60 years old and they want to trigger income at age 65. At age 65, they're receiving $10,000 of income from the annuity. By age 70, they come to a long-term care scenario. That insurance carrier that's offering the annuity will go and double their income to $20,000 for 5 years. So by age 75, then it would drop back down to the $10,000 amount. So now you're getting, an extra 50 grand in this example of monies that you didn't realize that you were eligible for no additional cost. It's just a way on how insurance companies don't have to strictly go into the long-term care insurance space, but they could still offer a long-term care benefit, that's just kind of blended already into their existing policies or their existing benefits. So a quick recap. Things used to be simple with long-term care insurance. You're able to just put monthly premiums aside, get your policy, and everything would either get paid out in a cash or to get paid out directly to that facility or their home health aide. Things have ultimately changed because individuals kept going out on claims. You had insurance carriers that really stopped offering these products. For the ones that still stayed compliant or still kept those policies, those existing policyholders happy, saying, yes, we will honor your policies, we'll honor the terms of those contracts, a lot of those carriers have increased those premium payments, therefore making it unaffordable for long-term care insurance. So a way on how an individual could kind of have their cake, eat it too, make sure that they're not throwing dollars aside, and even if they never use the cost of long-term care, if they never use that actual ever suffice a long-term care need, well, now they could have a death benefit need there. Even if they're just using it on an annuity platform and they're using income, well, they could get double income if, and that's just a hypothetical example, it could double their income if attaching that additional long-term care rider on there. Some carriers offer it, some carriers don't. Some carriers only offer it if you have, or if you're in a nursing home facility. Some carriers offer it with a home health care doubler. My recommendation is usually ones with a home health care doubler, because we understand that that's 80% statistically individuals use a home health aid over a nursing home benefit. But this is kind of everything, the whole breakdown of what I would recommend on a long-term care insurance need. Also understand that my recommendation might be different than other individuals, because I've seen firsthand individuals get very pissed off, and I've seen very large insurance companies increase those rates on long-term care insurance later after the fact, where these individuals did not realize that there was going to be a price increase. So that's why I have a sour taste in my mouth regarding individual or traditional long-term care insurance. So I would usually recommend you have really good products out there, some life insurance policies that act like a type of retirement savings vehicle that you could pull your money out at any time, but also give you additional long-term care benefits, give you additional death benefits on there, annuities that have that additional long-term care play. So it's all about allowing your single dollar to be leveraged in a multitude of different ways, and that's what my recommendations are for. So, if you found value in this video, if you're interested in hearing what the best results are, what the best contracts are, we're an independent agency. You give us a call 24 hours a day, 7 days a week. Morning, nights, weekends, holidays, whatever the case may be. When calling over, you're going to talk to an assistant. You'll tell them that you saw a video regarding long-term care insurance. You want to speak to a long-term care insurance specialist, and then that assistant's going to patch you over to one. That specialist is going to ask you a slew of questions, see what your current situation is, see even if it's necessary to go this route with long-term care, or whether you could just self-fund it, or use a traditional long-term care insurance policy. But understand, we have access to every carrier out there. We're going to be non-biased towards one carrier over the next. It's all about the individual. We try to educate you guys. We try to walk you through, hold your hand to help you really understand how these things work, how the process works. So we send you literature pieces. We send you personalized videos to make sure that you get fully acclimated. And we are A+ rated on the Better Business Bureau. I want to thank you very much for watching this video. Please feel free to subscribe to my YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks so much, guys.